social messaging startup IRL is shutting down after a board investigation found 95% of its claimed 20 million users were actually fake. This is a company that in June of 2021 raised $170 million Series C at a valuation of over $1 billion, making it one of the many proclaimed unicorns of Silicon Valley, led by SoftBank's Vision Fund. The investor who was sitting on the board said that they didn't know if we've ever given an investment term sheet to a startup faster than SoftBank gave to IRL at the time. At the same time, different story, but in the same week, a company called Baiju, which Chamath, you have talked about in the past, was once valued at $22 billion and claimed to be India's most valuable startup, is in turmoil as shareholders and creditors are seeking to dilute the founder, and he's rushing to find capital and raise $1 billion to try and buoy the company. Prosus, one of the investors, marked the company's valuation down to $5.1 billion, so down 75%. I guess the question is, overall, are we still seeing this kind of turmoil in Silicon Valley from the ZERP era funding of startups in stark juxtaposition to the excitement and the frenzy around AI?
It's a characteristic of the exact same thing. Meaning, if you replaced AI with crypto, it's the exact same thing. If you replaced AI with co-working, if you replaced AI with, I don't know, synthetic biology, if you replaced AI with SaaS, this has all happened before. I think it's important to identify what this is. What this is that there aren't enough checks and balances, and there are fundamentally people who are deeply inexperienced, who are in the wrong job. And in the few key moments where the venture capitalist is supposed to add value, that person is ill-equipped and unprepared. Why? Because they were the VP of X, Y, and Z at some startup, and they got hired through no fault of their own into a dynamic because these venture funds wanted to raise larger and larger amounts of money. So what happens? You don't even know how to ask the basic questions, or even more insidiously, you don't have the courage to say the hard thing. And so these things happen that are frankly inexcusable, right? So in the case of one of these companies, and I've mentioned this before, they approached us for financing. And when we asked for a data room, we got a Google Doc link to a spreadsheet. Now, there's no reasonable world in which a company is that unsophisticated when it comes to understanding their business, right? A data room should include an enormous amount of operational and financial metrics that you can use to come to your own conclusion so that you can present it transparently to the investor. The idea that boards wouldn't even hold these companies accountable is just a sign that the board members themselves are pretty fundamentally inexperienced people. And I think the thing that we do, which is a mistake, is we say, oh, well, X, Y, and Z firm led this deal. Yeah, that may be true. But really what it means is that firm, in a grab to get the money, hired some person that checked some boxes, put them in the job, that person led around, and there just wasn't any infrastructure to either teach that person or then that person to have the courage to hold the founder responsible. That will play out in AI as well. It's just that we're at the beginning of the hype cycle, right? Because we replace AI, again, as I said, with any of these other things. We sat here a little bit hand-wringing when we saw these crazy valuations for these NFT projects. Where are those now, right? So you name
Zero.
it. This is about fundamentally inexperienced people doing a job that seems pretty easy from the outside. But in practical reality, there are only a few legends in our business. Most people, and I think it was Shai Goldman that did the math on this, most people do not know how to run these businesses well. Nick will find that tweet you can show. I think it's like 2.5% of all of the funds that are in PitchBook, so over 800 of them, have ever generated more than 3x in two funds. So this is a hard business, it turns out. You can't just wake up and be an investor, it turns out. And that's what we're finding. So I don't know. It's not very surprising in the end. None of this is surprising.
Good summary.
I think Chamath had a really good point in the middle there, is that there is a generation of venture capitalists who were added during the boom, who were operators, but they've never been taught to have the discipline of capital allocators. And one of those key pieces of discipline is asking uncomfortable questions and doing uncomfortable diligence. And you can trust people, but you need to verify. That is a key part of the job. You can trust the founders, but you have to verify that the data you have is correct. The fact that SoftBank did this at an incredible valuation and the person who did this deal never checked that the customers were real is makes you unfit to serve in the job. And I will do diligence. And during that time period, Friedberg, I had many founders say to me, "You're asking for more diligence than the lead. And this deal is closing. And we are oversubscribed." And I said, "Okay." And they said, "Okay, so you're not going to require this." And I said, "Oh no, we require this diligence. We want to see your, very basic stuff, your bank statements, your P&L. We want you to give us a list of your first 1,000, give us a list of 500 customers from last month. We'll give you 5 numbers. We're going to talk to 5 random customers." Like, people did not want to do this stuff. We do this work at our firm when we start to own 5-10% of this, and we train our founders to be ready for proper diligence. All that diligence is happening now. Now, in the early stages, there's not much to go on, but you can check stuff. During this period, founders used the hot market to not participate in the due diligence process. And when you look at companies, a lot of times people will suspend disbelief. This company, Baijiu, I don't know a ton about it, but it seems to have, like an educational app, like a company, Brilliant.org, that Chamath and I are early investors in, and Chamath incubated. Great business. But then their business and their revenue seems to be based on a series of like Kumon, in-person instruction. Oh, that's not a high gross margin business. Sorry. If you have to have a storefront, you're not a software business anymore. And so people started giving valuations, and this is the second part, and I'll just wrap on this. People started giving valuations to these companies that were real world businesses, that were low margin businesses, direct to consumer, whatever it was. They suspended disbelief and they gave them valuations for high growth, high gross margin businesses. And that was another mistake. And you put those two things together, not doing diligence and then just misvaluing of actual assets, that's the cleanup work that's going on right now. And it takes years. I mean, it took decades for them to pinch Bernie Madoff. It can take 10 years for these frauds to come out. There was a guy who kept telling the SEC about Bernie Madoff. I think he was like 9 years since the first time he let them know that the perfect returns were just not possible statistically. So it takes time, but they're picking these folks up everywhere. Do Kwon got picked up in Montenegro, the guy from Luna. And it's going to take a decade to clean up all of the fraud in our space.
I think this was sort of mentioned by Chamath, but I think it needs to be a bigger point, which is the influence of fund size on these decisions. I mean, Kraft's funds are in the $600 to $700 million range. So when we write a check, it's usually $10, $15, $20 million check in a Series A company. That's like a big check for us. We're really going to sweat that decision. For SoftBank, a $10 to $20 million check in a $100 billion fund, which is what they had, it doesn't even make sense. It's a waste of their time. It's not even a rounding error. For them to basically make a decision.
It's like a $2,000 check for you.
Yeah, exactly. So for them, they had to write $200 million checks to justify their time managing $100 billion. And so the mistake, when they make a mistake, is 20 times bigger than it should be. That should have been maybe a $10 million mistake, not a $200 million mistake. But their fund size forced them to basically write these gigantic checks. And they were writing them into companies that were effectively seed stage or Series A companies. If it was into a growth stage company, I think that's fine. There's a lot more data and there's a lot more customer references that you can check at a later stage company. By the way, the number one part of diligence, I'd say for us, other than looking at metrics, which is anyone can do, is the offsheet references. Talking to customers from a list that you figured out yourself, not from the company itself, is probably the single most important qualitative part of diligence. So I don't know what happened here, but
it's not stated explicitly, but I think it's important. David, you have credibility. So when you say something, Sachs, people listen because you have bona fides that are undeniable. Same thing with JCal, same thing with you, Friedberg. I think, and this may sound mean, but it's like most of these people are just XYZ mid-level VPs from a startup. And that's a great thing. But it's not necessarily going to give you the gravitas, especially if that's not what you are forced to do to help build that company. And when push comes to shove inside of a boardroom or in the middle of diligence, There has to be conflict. I think it's a necessary feature of good decisions.